The LNG Global Quality Dividends is an exchange-traded fund established as an open-ended investment company with variable capital domiciled in Ireland. It is managed by LGIM Managers Europe Limited, a subsidiary of Legal & General Investment Management (LGIM). The fund's primary investment objective is to provide exposure to companies in developed market countries that exhibit higher-than-average dividend yields and a history of dividend growth. Launched in the fourth quarter of 2025, with its distributing share class commencing operations in January 2026, the fund targets investors seeking a monthly income stream derived from a diversified basket of global equities. Unlike traditional dividend ETFs that may prioritize yield in isolation, the LNG strategy integrates fundamental screens to mitigate the dividend trap phenomenon, where high yields are a symptom of declining share prices and deteriorating business fundamentals. The fund employs a physical replication method, specifically using an optimized sampling technique. This approach involves holding a representative sample of the securities that make up the underlying index to match its risk and return profile, rather than purchasing all constituents. The fund is classified as an Article 8 product under the Sustainable Finance Disclosure Regulation, SFDR, meaning it promotes environmental and social characteristics through its tracking of an index that incorporates ESG exclusions and criteria. The fund seeks to track the performance of the FTSE Developed All-Cap Dividend Growth with Quality Net Tax Indexed. This index is part of the FTSE Dividend Growth with Quality Index series, which was introduced to provide a more nuanced benchmark for income-seeking investors. The index construction methodology is rules-based and transparent, designed to capture three specific investment factors: yield, growth, and quality. The index universe begins with the FTSE Developed All-Cap Index, a comprehensive benchmark covering large, mid, and small-cap stocks across 23 developed markets. To ensure that the index is tradable and investable for a large-scale ETF, constituents must pass liquidity screens. Stocks that do not meet the minimum free float or trading volume requirements are excluded from consideration. The core of the index's alpha-generating potential lies in its triple-factor filter. This process systematically narrows the universe to companies that meet specific financial thresholds.
The first filter is the Dividend Yield and Growth screen. Companies must demonstrate a history of positive dividend growth over a 5-year period. This ensures that the fund is not simply chasing high current yields, but is instead investing in companies with a dividend culture, a management commitment to returning capital to shareholders. Furthermore, the index selects stocks with a relatively higher forward dividend yield compared to the broader market, ensuring the portfolio provides a meaningful income uplift. The second filter is the quality screen. The index excludes companies that have negative or zero return on equity, ROE. ROE is a critical measure of management efficiency and profitability. By requiring a positive ROE, the index removes firms that are paying dividends out of debt or through the depletion of capital, rather than from sustainable earnings. This quality filter is a primary defense against value traps and firms with deteriorating balance sheets. The third filter is the ESG and sector exclusion screen. The index excludes companies involved in controversial activities, including weapons, thermal coal, and those in breach of the UN Global Compact. Furthermore, specific subsectors such as real estate investment trusts, REITs, and mortgage REITs are excluded to maintain the equity income focus and avoid the unique tax and leverage characteristics of the property sector.
Unlike traditional market cap-weighted indices where the largest companies dominate the performance, the FTSE Developed All-Cap Dividend Growth with Quality Index utilizes a more balanced approach. While the ground rules allow for various weighting mechanisms in different series, the specific index tracked by the fund incorporates capping and pseudo-equal weighting elements to enhance diversification and reduce concentration risk. This approach ensures that smaller, high-quality dividend growers have a meaningful impact on the portfolio's total return and yield. The index is reviewed semi-annually in March and September. This frequency allows the fund to react to corporate fundamental shifts, such as dividend cuts or declining ROE, without incurring the excessive turnover and transaction costs associated with monthly rebalancing. The resulting portfolio is a broadly diversified basket of approximately 939 to 959 stocks. The sectoral and geographic allocations of the fund represent a significant departure from the standard MSCI World or FTSE Developed benchmarks, reflecting its value and income orientation. The fund exhibits a heavy concentration in sectors that traditionally offer high dividend yields and strong cash flows, specifically financials and industrials. Conversely, it is significantly underweight in technology and healthcare, sectors where companies typically prioritize growth reinvestment over shareholder distributions.
The dominant position in financial services, over 32%, is a defining characteristic of the fund. This exposure is a direct consequence of the yield and quality filters, as global banks and insurance companies often meet the criteria for high yields and positive ROE. While this concentration provides a substantial yield floor, it also introduces sector-specific risks. One of the most notable aspects of the fund's composition is its geographic diversification. Broad market indices like the MSCI World currently feature a 70% or higher allocation to the United States. In contrast, the LDGL Global Quality Dividends ETF has a more balanced global profile due to the more attractive dividend yields and lower valuations found in Europe and Japan. The reduced reliance on the United States makes this ETF an effective tool for investors seeking to diversify away from U.S.-centric portfolios. The inclusion of Japan, 17.18%, is particularly significant, as Japanese corporations have increasingly focused on shareholder returns and dividend growth in recent years. Due to the fund's all-cap approach and weighting methodology, it avoids the concentration risk typical of market cap-weighted funds. The top 10 holdings represent only a small fraction of the total assets, ensuring that no single company can significantly impair the fund's NAV. The portfolio's top 5 holdings account for only about 1.15% of the total assets. This granularity is a key defensive attribute, as it protects investors from idiosyncratic corporate events that could otherwise impact a more concentrated dividend fund. By targeting companies with positive ROE and consistent dividend growth, the fund maintains a better valuation profile compared to the broad global equity income category. The fund's price-to-earnings ratio of 13.05 suggests that investors are paying a significantly lower multiple for each dollar of earnings compared to the category average. Moreover, the sales growth of 2.71%, outperforming the category average of 1.54%, suggests that these companies are not merely stagnant value plays, but are growing their top lines more effectively than many of their income-focused peers. The fundamental commitment to quality is reflected in the ROE and growth metrics. While specific ROE averages for the full portfolio vary, the index methodology's requirement for a positive ROE serves as a floor. The long-term earnings growth rate of 8.26% exceeds the category average, providing further evidence that the constituent companies possess the financial strength to sustain and grow their distributions. The LDGL Global Quality Dividends is designed to provide a stable monthly income. The distributing share class, LDGL, targets a consistent per-share distribution informed by the portfolio's forecast yield. For the first half of 2026, the fund has maintained a consistent payout of approximately $0.0353 per unit per month. The forward dividend yield is estimated at approximately 3.98%, which provides a significant income premium over the broad MSCI World Index. This yield is generated from the underlying dividends of the portfolio companies, as the fund does not use covered calls or other derivative-based income enhancement strategies that could cap capital appreciation. While the ETF itself is relatively new, having launched in late 2025, the underlying index has an extensive historical track record that provides insight into its performance characteristics across various market cycles. The FTSE Developed All-Cap Dividend Growth with Quality Index has historically delivered competitive total returns with a distinct risk-return profile. Over the last 15 years, the index in euro terms achieved a compound annual growth rate, CAGR, of 9.96%. In 2022, a year marked by significant equity market declines and rising interest rates, the index proved resilient, returning plus 0.12%, compared to a double-digit decline for the broad MSCI World Index. This outperformance during periods of market stress is a hallmark of the quality dividend factor combination.
Investing in the LDGL Global Quality Dividends involves several risk categories that could impact both the capital value of the investment and the stability of the income stream. High dividend equities often act as bond proxies. In periods of rising interest rates, the relative attractiveness of dividend-paying stocks decreases compared to government bonds. This can lead to a dual headwind. First, an increase in the discount rate used to value future cash flows, which lowers stock prices. And second, a rotation of capital out of income stocks into the fixed income market. While the fund's quality screen, ROE greater than 0, ensures that the companies are profitable, it does not immunize them from macro valuation shifts. However, a potential decline in interest rates could act as a significant tailwind for the fund, making its nearly 4% yield even more compelling for investors seeking alternatives to cash or bonds. The fund's heavy concentration in financials, approximately 32%, and industrials, approximately 20%, creates a significant sector-specific risk profile. The financial sector is highly sensitive to regulatory changes, interest rate spreads, net interest margin, and broad economic sentiment. A systemic crisis in the global banking sector would have a disproportionate impact on the fund's NAV compared to a more diversified benchmark like the MSCI World. Conversely, the fund's significant underweight in technology, 4.5%, means it will likely underperform during periods where growth-oriented megacap stocks are leading the market. This anti-momentum risk is inherent in value and dividend-focused strategies. As the fund is unhedged, its returns are subject to currency fluctuations. While the base currency is USD, over 70% of the fund's assets are located outside the United States, primarily in Japan, the UK, and Europe. If the US dollar strengthens significantly against the Japanese yen or the euro, the value of the fund's international holdings will decrease when converted back into USD, leading to a decline in NAV even if the underlying stock prices remain stable. Furthermore, the fund's 17% allocation to Japan and nearly 25% to Europe means it is sensitive to the geopolitical and economic developments in these regions. For instance, a prolonged economic slowdown in Europe or a change in the Bank of Japan's monetary policy could significantly impact a large portion of the portfolio. Because the fund uses an optimized sampling replication method rather than full replication, there is a risk that the performance of the ETF will deviate from the performance of the underlying index. Academic research suggests that sampling funds can sometimes trade more frequently than full replication funds to maintain their representative profile, potentially leading to higher internal transaction costs and lower annual returns.
For the LNG fund, the sampling approach is necessary to manage its all-cap universe, which includes hundreds of smaller-cap stocks. While sampling reduces the overhead of holding very small positions, it introduces the risk that the most relevant constituents selected by the manager do not perfectly capture the performance of the broader index. As a relatively new fund launched in early 2026, LDGL has a smaller AUM, approximately $121 million to $145 million, compared to multi-billion-dollar competitors like Vanguard FTSE All-World High-Dividend-Yield ETF. Lower AUM can lead to lower on-exchange trading volume, which often manifests as wider bid-ask spreads. As of April 2026, the absolute spread was reported around 0.358%. While this is reasonable for a global equity ETF, investors executing large trades should be mindful of liquidity and use limit orders to minimize execution slippage. As an Article 8 fund, LDGL is committed to maintaining its ESG credentials. This introduces the risk of exclusion drag, the possibility that the sectors or companies excluded for ESG reasons, such as thermal coal, perform exceptionally well, causing the fund to underperform unconstrained benchmarks. Furthermore, the evolving regulatory landscape for ESG disclosures in the EU, SFDR, means that the fund's classification or methodology could be subject to changes that force turnover within the portfolio, regardless of financial considerations. A defining second-order characteristic of the fund is its all-cap nature. Most dividend ETFs focus exclusively on large-cap companies for their perceived stability. However, the inclusion of small caps in the LNG strategy allows it to capture the full dividend stream of the developed markets. Small-cap companies that meet the quality and dividend growth criteria are often in a unique phase of their life cycle. They are profitable enough to pay dividends, ROE greater than 0, but still have significant room for expansion. By including these companies, the fund gains exposure to a segment of the market that is often overlooked by income investors. Furthermore, the fund's use of pseudo-equal weighting, as opposed to market cap weighting, ensures that the portfolio's yield and return are not dominated by a few mega-cap names. In a market cap-weighted fund, the top 10 companies might account for 25% of the portfolio. In LDGL, the top 10 companies account for less than 4%, providing a much more robust diversification profile and reducing the impact of a dividend cut from any single large constituent.
The monthly distribution of the fund is not just a marketing feature, but a significant operational commitment. To provide a stable monthly income, the fund manager targets a consistent payout per share. This requires careful cash flow management within the fund, as the underlying dividends from 940 stocks do not arrive in equal monthly installments. European companies, for instance, often pay annually or semi-annually in the spring. Investors should note that while the fund aims for stability, the distribution amount is informed by the portfolio's forecast yield and is not a guaranteed fixed amount. Significant shifts in global exchange rates or widespread dividend cuts in the portfolio could lead to adjustments in the monthly payout. Conclusion: by synthesizing the three factors of yield, quality, and growth, the fund addresses the traditional pitfalls of dividend investing. The fund's all-cap approach and its significant underweight in U.S. technology provides an effective diversifier for investors who are currently overexposed to market cap-weighted global indices. While the concentration in financials and the inherent risks of currency and interest rate movements must be carefully monitored, the fund's quality filter, ROE greater than 0, and its broad diversification act as significant risk mitigation tools.